So we
Sorry.
so we are it's okay. So we are team 8 and we will be going over our People Express strategy. My name is Montse.
I'm Kyle.
I am also Kyle.
I'm Rich.
And I'm Sergio.
So to begin, we're going to go over our table of contents. We're starting with the big picture of our project and strategy, and then we're going to go into our competitive position and then our key decisions within our company, like the decisions regarding aircraft acquisition, people's fare, hiring employees, our marketing fraction and service scope. And then after we talk about our decisions, we're going to go into our results, like our financial results, solvency, our operating efficiency, capital structure, and more. And lastly, our conclusion. So in our 10-year simulation, we reflected on our experience with the John Birch simulation strategy and used that experience as well as our knowledge from class to guide our decisions. We decided early on that we wanted to start and stick with a steady and predictable growth strategy in most of our decisions. The steady increase is reflected in our airfare price, the airline acquisition, but we did keep some variables constant, like our marketing fraction and target service scope. This decision to keep constant variables allowed us to keep consistency in our strategy, and it made it easier for us to pinpoint what changes to variables affected us negatively. Although our competitors may have had more resources than we did at the starting point, we understood that it takes time to accumulate resources, and throughout our many trials found that jumping straight into aircraft acquisition led us to burning through our resources we begin with. So for our competitive position, we aim to increase our market share and stock prices in a healthy and sustainable way. We wanted to achieve a competitive advantage through offering low prices. Because of our method of slow, steady growth, we were able to offer customers a very, very low prices compared to our competitors because of our low operating costs in the initial years. For our price position, our pricing began at 0.09 and slowly increased to 1.25, which is still slightly lower than competitor fares. Our prices reflect the growth of our company. The first increase came in year 3 when we began acquiring aircrafts and grew as our fleet did. Our target service scope remained at 0.7 throughout the whole simulation, and we wanted to remain above 0.7 throughout the whole simulation, but our service quality was below our target from years 2 to 5, and again in the third quarter of the 6th year to the end of the 8th. For our target growth rate, we wanted to increase our market share by at least 500% in the 10-year simulation, considering how small we were, and our calculations showed that we exceeded our target by an additional 500%. Next, we're going to go over our key decisions.
One of our key decisions was aircraft acquisitions. And looking at this chart on the right, in that first section, we actually did not hire we didn't have any aircraft acquisitions the first 8 quarters. And this was an advantage because when sales and return on sales took a dip, it was minimal and we were able to turn it around. And the second section, we started to increase our acquisitions by 2 to 3 per quarter. And we continued this through the 10-year simulation until we hit our goal of 75, and we actually beat it by going over 80. And then looking at the people fare, we use penetration pricing, meaning that we set our prices a lot lower compared to the competition. Looking at this first section, we had our prices a lot lower. And the second section shows how we were able to increase the competition until we leveled it out in the end to where our prices were the same. And then looking at our hiring decisions, we had to make sure to match employee turnover with our aircraft acquisitions to where they leveled out. And you can see this here in the first section. We started to have a lot more acquisitions, so our hiring went up. And we continue this through the second section. And we also had to expect for future losses, so we made sure to hire more than we would lose to level it out. And in this last section, we did have a large turnover, so we had to really increase our hiring.
For our marketing fraction, we set aside 10% for every quarter throughout the 10 years. This decision was made because we deemed it important to always invest at least 10% in our marketing, no matter how we were doing financially. And the steady increase you see in the graph to the right correlates with our revenue increase. Next slide. So our service scope remained at 0.7 throughout the entire simulation compared to our competitors who set theirs at 1. Our reported service quality dropped below our target a few times throughout the simulation, but improved and it eventually exceeded our competitors in the last few years. And next, we're going to go over our results.
Okay, so for our overall financial results, revenue was able to increase each year along with the marketing share price. The final net income at the end of year 10, quarter 4 was 106 million, but the highest it reached was 189.5 million. The lowest was in year 4, quarter 3, but as you can see in the graph, eventually it increased again, where it hit that 189.5 area, but then lowered once again, but there was no indication it would keep getting lower. As for the stock price, it was a steady increase with a similar trend to the market value, but had no huge differences, mainly just a steady increase. Next, we will look at the liquidity and solvency. So as you can see from the graph, each cash flow had similar trends except for the investing cash flow. Year 8 is where we saw high in net income, and that's visible on the red line on the graph. Each line was similar in cash flow, showing that they had started low and then hit their peak around year 8 before falling off slightly. Cash flow from investing, however, did not increase at all and only went down. Everything else was satisfactory, but as a company, it would be important to look at the investment cash flow and consider a new approach since it was losing money, which affects the entire net income. With that, we will move on to operating efficiency. So as you can see from this graph, that looks like a mountain. There was an incline in year 2, quarter 2, but that dropped down gradually until it increased again in year 4, quarter 4. It didn't quite reach as high as it did in year 2, which is why we see the second peak in the graph still slightly below the year 2 peak. Cost of capital stayed low since people fare was low and able to attract customers consistently, even though service scope was also low at times. As mentioned before, it recovered at the end of year 6, but then declined after. Only 2 quarters going below the cost of capital, I would consider this still satisfactory. Next is the capital structure. Capital, it started declining early, but eventually was leveled off into the end of year 10. However, break even reached a low of 0.31, so it's important to follow that number further to see if it continues to decline. Otherwise, the company will be losing revenue because of the exceeding costs. Should also be noted that people fare was almost equal towards the end, so this could eventually sway customers to not opt for the cheaper option presented. This could lose customers to competitors since there's not a big enough difference in price. But given the results within 10 years, I would consider it still satisfactory, but in the future, there are definitely things to look towards to keep revenue above cost. And the next slide will cover leverage safety.
So with leverage safety in our capital structure, our times interest earned ratio was our biggest indicator for this. And throughout the first 8 years, this number stayed very consistent due to the fact that our debt was staying consistent with our asset and our revenue growth. We did have a little spike here around year 2, at the end of year 2 and the beginning of year 3, but right around year 8, as you can see, this big spike, this first spike right here, that is due to our debts essentially being eliminated, except for small short-term loans and things like that, that were keeping our times interest earned ratio from spiking, like the second one, where we were able to increase our revenue by 900 times our 900 times our interest charges that were earned. Because our interest charges were so low, we were accumulating such little debt, but we had such high gains compared to our initial years. We were able to keep the times interest earned ratio incredibly high until, again, our revenue dropped back down towards the end of year 10.
So the next we'll talk about will be customer demand. So as an airline carrier, one of our goals was to maximize our load factor so we can sell as many seats as possible on all of our flights, thus creating more passengers and more profit. However, customer demand was an issue for us at times. Our passenger growth rate was unable to keep up with our overall growth rate during years 3 to 7. But after year 7, we were able to push it back up and get it to consistently rise above the break-even load factor throughout the rest of the simulation. One of the problems I think we had with our load factor was we tried to grow too fast after we started off slow during the first 2 years without acquiring any aircrafts. And thus it caused us to kind of have a discrepancy between our passengers and our aircrafts. And then also, as you can see, our growth rate was pretty sporadic. It shot up after the end of year 2 when we began to acquire aircrafts, and then came crashing back down and kind of became interchangeable with our passenger growth. And then at the end of our simulation, though, we were able to get a grip of it and create more capacity growth rate than passenger growth rate, which led to more profits. And then for our service quality, at the end of our simulation, it was satisfactory. We were able to keep our service quality above the rookie fraction throughout the 10 years. As you can see, it did get pretty close to the rookie fraction at the end of year 2, but we were able to correct pretty quickly with that and build up our service quality back up to where it was before, and then finish strong. Our average hours worked per week was above the average 40-hour work week. We started around 43, and then we rose all the way up to 60 at one point, and then finished at around 45. And then our employees per plane started below the Don Burr numbers, and then hovered right around the line for Don Burr. Instead of a stagnant employee per plane number, as shown in Don Burr, we chose to steadily increase and decrease our number to adapt to volatility and increase performance, which led to us increasing our market value and revenues. And then for productivity, we were able to maintain a satisfactory productivity number above 1,500 throughout. It was kind of a, as you can see on the graph, kind of a bumpy ride there for a little bit with our productivity. We did take a dip, as with other aspects of our business, at the end of year 2, but we were also able to correct that at the end of year 5, and then eventually, take a small dip, but nothing too drastic as we finished off the simulation. And then our employee turnover took a hard dip after year 2. However, we were matching the turnover with our hiring numbers. So as we continue to lose employees, we would also go out and hire more employees to make sure that our employee to aircraft ratio was correct. And then our value per employee was pretty solid. We were able to, in the long run, increase our value per employee. We had some highs and then we had some lows, but at the end of our simulation, we were higher at $1,000 per person basis than we started.
And then to round out this presentation, we're going to talk about our conclusions about the simulation and what we learned from this entire process. So first, talking about the system's perspective of People Express, the key connections we found in the system were the increase in aircraft's effect on generally every other variable that we were dealing with, like from going from operating revenues all the way to marketing share, as well as hiring decisions impact on the service quality, productivity, and even turnover, as Rich was just speaking about earlier. Our market value for the first 5 years was not increasing by a large margin. And the reason for that is because we were still growing our aircraft acquisitions at a slower and steadier rate, especially in the first 2 years. But once we were able to get rid of that debt, as we talked about in the times interest earned slide, we were able to create much more revenue and also grab much more of that market share due to our decreased prices from our competitors. So we had more ability and a higher load factor for all of our customers, but we were also able to satisfy their looking for cheaper prices, and that's why we were able to grab this larger market value towards the end of the simulation from years 5 through 10. As we said at the beginning of the presentation, our strategy was to keep certain variables in a controlled constant for as many quarters as possible, while still promoting growth through the company, and manage as many unforeseen variables as possible by having these stable increases. The results were steady increases to our revenues and cash flows, and they allowed our market share and value to increase much larger due to the increased acquisitions. The only issue was that dip in their return on assets and our return on sales due to the fluctuations from turnover as well as profits and things like that. Overall conclusion, keeping our prices under competitors for as long as possible was a big reason we were able to maintain a steady income while also increasing the market share. We also did, like talked about previously, we slowly ramped up our aircraft acquisitions, starting with none and then getting all the way up to 5 at the end of it, until our costs caught up to us and we had to cut that back down to 3. Changing certain factors like marketing amounts and service scope didn't really help us in the end when we did try these in a few other simulations. They just became too volatile. They changed too many other unforeseen variables in our costs, and it made our balance sheet and our market share not look as good as it could have been. So we decided to forego these changes. I believe all of us learned that all of these seemingly small decisions and simple adjustments, like we just talked about with the marketing amounts and the service scope, those little things obviously can have large effects, but also the little adjustments like hiring and having to increase hiring for turnover or increase hiring for hiring decisions, hiring people to hire other people. There's so many things that you might make small decisions for the first 5 years of the simulation, but they'll have effects on the full 10 years, and those effects can be drastic. In the reference of strategy dynamics, we were able to use strategy dynamics, and that was a big part of our success by focusing on the resources like customers and employees rather than trying to just maximize revenues. We were able to control many more aspects of the business and allow it to grow. Tested many different levels of aircraft acquisitions to try to keep this load factor as good as it is in the graph that you see to the right. But by undercutting competitors' prices along with this, we were able to create value to our customers while also undergoing this rapid growth with all the aircraft acquisitions, which kept our load factor just as high while we were acquiring 4 planes per year, as you can see in the year 5 through 8 of the load factor graph. Also, as the years went on, one major outflow of resources that hurt the bottom line was turnover and hiring, because that cut our productivity. It made our hours go up to 60 hours a week for average work week, which was pretty high for our line of work and everything like that. And the average is 40. And so those expenses increased every year commensurate with the number of airplanes we acquired. And that is our presentation. Thank you for watching, and I will end it there.